record button. Yeah, so with that being said, I'm going to move into doing the review session for today. So for today, I'm essentially going to review what we've basically covered in like the last 4 weeks or so, right? So we started on what, December 3rd? So I'm just basically going to review everything that we've covered since starting the program to give you guys a quick rundown of the subject of technical analysis, going over all the modules, and I will focus on some of the key things from every module that we have that I think you guys should absolutely know with a high degree of certainty and confidence and the ability to apply the material. All right, so I'll focus more on that, and I'll focus less on, you know, like the more mundane stuff that we've covered in the actual classes. Okay. So with that being said, let's just give me a second here. Pull up all these modules. Oh, by the way, guys, I've heard from one of another person that I was working with that Smart Prime Broker is giving people some issues signing into their account or getting started with an account. If you're in that situation, I have a couple of other brokers that I can recommend you. So just let me know if you're running into issues with Smart Prime. And I can recommend other brokers for you. Okay.
China December manufacturing PMI at 50.2, EST 50.1. China December non-manufacturing PMI at 53.5, EST 54.2.
All right, guys. So hit the record button. We're recording now, so let's just jump into this and move forward. All right, so technical analysis part 1. In the first portion of technical analysis, when we first started covering this, we focused more on charts, candles, looking at support and resistance, and understanding the dynamics of the market, right? Like the characteristics of the market, and understanding how the market is always moving in a sideways momentum, in an upwards momentum, or a downwards momentum, right? And as we go through this, I'll focus on, again, some of the key things that you guys should be aware of. So first and foremost, charts. By now, you guys should know that there are many charts available to use, but the default one that we all use and we all look at ubiquitously is the candlestick charts, right? The candlestick charts, simply because they provide you with the most information within one candle time frame, right? So some of the other charts that you have available are line charts, Heikin-Ashi charts, which uses a momentum indicator built into individual candles. You have Renko charts, which is also another type of momentum style of indicator. And then lastly, you have the candlestick charts, which is the one that we primarily focus on. The candlestick charts, they're created by sorry, let me rephrase that. It was created in Japan, like way back. And that's why they're referred to as Japanese candlestick charts. But you know, it's so ubiquitous now, we just refer to it as candlestick charts. Like nobody calls it Japanese candlestick charts anymore. But that's just what it is. Each candle represents a time frame. So each one of these individual candles, you can change the time frame to them. So it could be like 1 second to like 1 day. And the candle just represents the high, low, open, and close. So each candle is as such here. You have the high, low, the opening, and the closing of the candles. And the wicks just represent the highest and lowest price traded. The body represents where the market opened at that specific time versus where it's closed. And the green candles and the red candles just denote where the price has closed for that specific time frame. So if you have a candle where the price opened low and closed high, that's obviously a green candle. And vice versa, if the market's open high and closed low, then that's a red candle. Right? So that's very straightforward. Couple of things with candles, like the more elongated the candle, like let's say for example, if the candle's like this, right? That just basically means like the volatility is extremely high during that period in time. And if you get like a candle that's like this, you know, that just basically means that the volatility during this point in time is extremely low, right? Now, high volatility and low volatility can be related to many factors, such as like a news-driven event, macroeconomic data being released, some type of information, fundamental or micro, that came out and caused a lot of buying and selling behavior to take place. Or it could just be purely price action at a very specific time during the day. In a 24-hour cycle, there are certain hours that are more popular to trade than others, right? And so if you caught the market at like 9:30 in the morning, you'll probably be trading in a period of time of heightened volatility. So you can expect candles to be very elongated, right? Whereas if you're trading at like midnight or like 9:10 or like right now, you can expect products to be very, very you can expect volatility to be very, very low. So the candles themselves there will be very, very low when it comes to trading. Okay, so those are just some examples of how the market behaves, so to speak, during certain times of the day, and how it affects the price action of the actual physical candle, right? Like the way the candle looks is affected by the price action, and that has many variables that affects that process. So when it comes to looking at candlesticks, right, we can look at individual candles and get information and meaning out of individual candles, or we can also look at a series of candles and get information out of what the price action is trying to tell us based upon what has happened during that time frame. So when we look at individual candles, we usually look for candles with like very long wicks or very low volatility in relation to the open and closing price, right? So if the opening and closing price has very low volatility, but the actual time frame, like the trading behavior is actually quite high, but the opening and closing price, the body of the candle is relatively small, that usually is a very strong sign that you may see some type of tug of war taking place within the markets. So these are very common. You'll find these in like dojis, you'll find these in hammers, you'll find these in morning stars, hanging mans, etc. So what I mean by this is that you're typically looking for very long wicks, right, with very low bodies or very small bodies, right? And these are usually very strong signs of reversals within the market. So that's a very, very, very distinct candlestick pattern that you're looking for in a market. And when you're looking for patterns like this, you're looking for a series of downtrends to take place, right? And then you see a candle like this, and the idea here is that a reversal in the market is about to take place, right? So that's what you're basically getting. These candles represent very strong reversal signals. So again, here's an example. You can see here in this example, the body is almost non-existent in this candle. It's almost all wick. So those are usually very strong signs of price reversals within the market. So hammers, hanging mans is the same thing. Hanging man is just the opposite of the hammer, right? In this case, you're looking at an uptrend taking place in the markets, and then you're being presented with a very small body candle with a very long lower wick. Right? And then again, that's usually a sign of a trend reversal in the markets. You can see here in this example, the wicks is pointing down. In the hammer, the wicks is also pointing down, right? So you guys just make sure that when you see like a long wick within the movement of a price, that it usually is representative of a reversal or some type of exhaustion in the markets from one side of the market. It's either buying exhaustion or selling exhaustion that's taking place, and that's where you're seeing that long wick coming in. Okay, so again here, another example of that. Shooting stars, again, same concept, same idea here. Is what you're getting out of this. After the shooting star patterns, you have your dojis. Your dojis is just candles where the opening and closing price are essentially equal, right? And they basically represent a balance or an equilibrium within the markets. So here's some examples. You have your long-legged dojis, dragonflies, gravestones, and four price. So your long-legged doji is just basically like the equal, right? It is like the most equal type of doji you can get. The price opens at a specific price, closes at the same price that it opens at, but it tested a high price and it tested a low price. It went up. Let's say the price opened at 5, it went up to 10, went down to 0, and then it closed at 5, right? So it's very equal in the sense that it went up to a certain amount and it went down to a certain amount, but that the up move and the down move is completely equal, right? That's basically the concept of a long-legged doji, is that the price movement up and down is exactly the same. The opening and the closing price is exactly the same. Again, long-legged dojis, very good signs of reversals within the markets. Dragonflies, so dragonflies and gravestones, they just represent buying or selling being dominant, and then the buyers and sellers reverse back, right? Depending upon whether you're looking at a dragonfly or a gravestone doji. So that's the general idea, is that the price tries to go down or up, and then it gets bought back up, and it closes at the same price that it opened at in a dragonfly or gravestone doji. In a four-price doji, this is like the worst candle that you can ever encounter. If you ever see a candle like this, do not trade that product. What it basically means is that the product, the candle, all right, like we can give this pricier number, okay? Let's just call that 100, right? At this candle, at this price, at this time right here, the market opened at a 100. It traded a high, so the high is 100, the low is 100, and the closing price is 100, right? So what that basically means is that your open, high, low, and close is unchanged, right? It stays at the exact same price, and that price can be any price. But the worst part about this is that if you see a candle like this, it just basically represents that no one is trading this product. No one is in the market right now. It's a very illiquid market, which is why no one is buying, no one is selling, and the price remains constant. So if you ever see a candlestick that's just a line like that, run away from that market. Do not trade that market. Do not trade that product. Do not trade that stock, because it is a terrible product to trade when you see little lines like that. And I'll give you guys an example here. Take a look at a stock like Apple. Okay. So you can see here in a stock like Apple, if you look at like 15 minutes, you can see here candles are relatively very strongly pronounced, right? Even in a 3-minute, you can see candles are very strongly pronounced, right? Every now and then you see like very small candles that may kind of look like a little dash there, like little small candles like this one. But this has more to do with the holiday liquidity rather than the product itself, right? So if we go back to like pre-holiday time during like the beginning of like December, you can see on a normal day, Apple shares trade in like a very nice fluid pattern, right? There's a lot of price action, a lot of volume going through. When you're trading on a product that's very illiquid and not a lot of volume and liquidity goes through, you'll get something like this. I don't know, if you take a look at a penny stock like this, okay? When you take a look at a penny stock like this is what I mean about that line right there, right? These candles right here is the primary reason why you do not want to trade. Sorry, that should be an arrow. This is the primary reason why you do not want to trade this, because it basically means there's no liquidity in the market. So you want to avoid trading that, right? So if you see candles like this, avoid it. Luckily for you, all the major markets that we look at, Forex market, and we look at all the major Forex products, they never have candles like this. When you look at large stocks like blue chips and large cap stocks, they never have candles like this. When you look at like products like crude oil, S&P 500 indexes, or bond market, gold, they never have candles like this. So the only time you have to worry about encountering a candle like this is during very illiquid times in the market, or if you're trading a product that is not popular in the markets. Okay? Any questions so far?
No, man.
No? Okay. All right, so now we're getting into like a series of candles. So here's like your series of candles, which basically shows you like a reversal pattern, right? So in this series of candles, what you're looking for is a large red candle, followed by a small body candle, followed by a large body candle, right? And this here is a reversal momentum again. It's just basically showing you that if the market is coming down and you experience a pattern like this, then the market is likely to begin to reverse itself. And they come in different variations. So the second candle here does not have to be green. It can also be red, and it will still represent relatively the same thing pretty much. Again, you see here a reversal signal in the markets. Okay, evening stars again. This is the opposite of the morning stars, whereas the morning star is a reversal from a downtrend. A evening star is a reversal from an uptrend, right? So the market is basically going like this, and what you're seeing here is these candles giving you a signal that the market is about to reverse from the rally and begin to pull back. So again, same idea. Second candle here just needs to be doesn't need to be a red or green candle. It could be either or, right? And again, the meaning of this is pretty much the same. Okay. Now we're gonna get into the part where we cover multiple candles, so like more than one candles, and the meanings behind multiple candles. Okay, so here's a reversal bar. So your reversal bar is just pretty much kind of like, you know, add like this here, right? You add this here, and then boom, it becomes like a morning star, right? A very similar idea in that sense is that you're looking at two candles in this case, right? But the reversal bar is just basically telling you that the market's about to go back up, right? And if you combine a third candle there, you can just basically call it like an evening star. So it's pretty much very similar in that sense. In the reversal bar signal. So key reversal. A key reversal or an eclipse is just basically a sign showing you that there is more volatility going into the markets now than there was before, right? So this candle right here shows that there was very little movement in the price direction. The next candle is just basically showing you there's more volume, more price action, more participation in the market. So volatility is increasing. Now, whether the volatility is going to be increasing and moving the price to the upside or to the downside, that is something that is hard to decipher with the key reversal signal, simply because the candle is eclipsing the previous candle, and it could have wild swings and then essentially end up like right back down here where the first candle is. Like the price could swing up high or down low, right? And then the next candle could just be printed. Oops. Wait, hold on 1 second. Here. The next candle could just be printed like right here, like that, and just trade like right back in this area right here, kind of like forming like a point of control within this specific area. So that's the issue with the key reversal, that you need a little bit more information to figure out which direction the market is going, right? Now, if you follow like news, information, momentum, and things like that, you can kind of figure out that if there's a lot of buying pressure, then the market is likely to continue to push up higher, and vice versa. But again, you'd have to really follow that market to get a sense of what's going on. Again, here's an example. These type of things typically happen in the stock market quite a bit, and they usually happen at the opening of the market, right? So I don't know if I can show you an example, but let me see.
Note of the FX option expiry for Tuesday, December 31st, 2019.
Thought I saw one on Tesla a while ago, but I guess not. Okay, let's just move on from there. Okay, next one is referred to as an exhaustion bar, right? Now, what characterizes an exhaustion bar is the gap. The gap just basically represents the absent area where there's no price traded between one candle to the next. Now, what happens in the exhaustion bar and the gap is that the price gaps, and it could be because of a transition from one day to the next. You know, like the closing day, the closing price of the previous day, and the opening price of the next day could cause a gap in the price. Now, what happens in the gap is that gaps tend to reverse themselves quite a bit, right? And so they create good opportunities to trade. So, well, what happens here in a gap trading scenario is that if the price trades below the gap, sometimes the price will reverse back up and clear this gap area and come like right to here, right? So that's the thing with gap trading. And I can show you guys lots of examples of gap trading. Let's use, okay, here, Tesla. So here's, this is a good example. You can see here, this was the price traded on the 23rd. This is the 23rd, right? This is the 24th. And that's today, right? That's today's trading behavior. And you can see here when the price gaps from here, right? So if you take a look at this, right here, if you take a look at that level right there, right? When the price today, when the price broke below this level right here, right? We can say that this area here acts as like a gap zone, right? And where does it want to go? It's likely wants to go and retest one of these levels down here, right? And so what happens in the gap? When the price trades into a gap area, you can see how quickly the price goes from like here to here, right? You guys see that? You guys see how in the 3-minute candle, how quickly the price went from here all the way down to this gap area? It took like literally like 3 minutes for it to do that, right? Now that's the idea with gap areas, right? And gaps tend to work really, really well in the markets. You know, so I'm going to show you guys a couple more examples of how gaps work in the markets, right? You know, usually when you get like big pushes in the markets like this, like in here, here's another example here. You guys see down here, see this area right here where the price is traded, right? And the price closed right here before it gapped lower down to here, right? And when it comes back up, guess where it goes up to? Guess where it goes up to? It hits that gap before it does a pullback and then continues it, right? So that's why gap trading becomes really, really good in the markets, because it gives you clear profit target levels, right? Like everybody can see that, okay, if the price was trading here and it dropped down to here, right? But it couldn't go below that level, right? You see how the price dropped down here? Could it retest this level down here?
Yeah.
Right? If it can't retest that, it's going to go back up. Well, where's the next probable profit target level for this to go to? It's going to go to that last price right here where it gapped from. And so when you do that, look at where the price goes. Right? You see the price here rallies, it goes up right to here before it sees some meaningful pullback. It breaks it and then continues to go higher, right? That's the idea with gap trading. Gap trading works really, really well. And if you understand this concept, you'll make trading for yourself very, very much easier, so to speak. One gap area, a couple of gap areas I'm looking for in the markets right now, specifically in the Forex market for you guys, is I'm looking for this right here, this level here to be retested on the pound, right? So you guys can see all this absent area right here. See how the price pulled back down and it's trading back up here? I'm looking for this to come back up, right? And so this trade right here is a good trade for the gap trade. That's one that I'm looking at in terms of like a gap trade. And then another one that I'm looking at right now is this trade right here on USD CAD. You can see how the market went and tested here. 1, 2, and now we're testing a third time, right? And guess what? If we break that, I think USD CAD could have the potential to do a very strong run in the first quarter of 2013. 2013. 2020. So in the next 3 months, we could see the Canadian dollar experience some pretty rapid appreciation in value. That could see it at 129, possibly even 128, like down here, right? And this is just purely analyzing this from a technical perspective. So you can see here from a technical perspective, right? We have this ascending triangle, right? And a triple bottom being tested right here. So any break of this right here will cause us to drop down pretty rapidly. Okay, so these are just some trades that I'm looking at, and the reason why I'm looking at this specific trade and pointing them out as good opportunities is because take a look at this, guys. When was the last time the Canadian dollar tested this price area?
Came back in September.
Yeah, we haven't tested this price area here since November of 2019.
Oh, sorry, yeah.
Right? September, November 2019, right? And so the idea with gaps is that as soon as we break this level right here, guess where the price is going to go? That's going to be the next target for the price, right? And so that's why when you understand gaps, it gives you a very good understanding of how to position yourself for taking profit targets, as well as positioning yourselves for preempting a trade, right? Like for me, like right here, like I'm looking at this and I'm just like over the last couple of days, man, I like conflict with myself, right? I'm like, on one hand, I know I shouldn't be trading because there's no volume in the markets. But on the other hand, I see this technical pattern right here and I'm like, I want to be on this pattern. I want to be on this trade, right? But you know, I have to, I find myself exercising discipline and just by saying, you know what? Just let the holiday and the New Year stuff pass by and then jump back in the markets, right? You know, you don't want to experience FOMO. You know, you just kind of want to just let the trade play out. You know, you don't want to force the trade. I don't want to force the trade, right? And so I'm waiting for this trade to do a little this. If it does a little this, I'm going to be looking at this as an opportunity to be shorting it all the way down to that level down there, all the way down to this level down here. Right, so these are some of the trades I'm looking at from a purely technical perspective. And the reason why I show you guys these two trades specifically is because they use gaps and exhaustions within their trade setups. Does that make sense?
Hey, Champ,
Yeah.
are we allowed to like short right away when we open an account, or we have to have?
You can short right away when you open a brokerage account to trade Forex or to trade futures. You are allowed to short the market right away. The only time you can't short a market is if you trade stocks. You would have to go through an additional layer of like paperwork to open up a margin trading account, which will allow you to short stocks. Like, let's say, for example, if you wanted to short stocks with like your RBC direct investment account, you wouldn't be able to do it. You can only go long. You can only buy, right? If you want to short stocks, you would have to use a more trading broker, like a broker that's more focused on trading, not retail banking. And you probably have to focus more on a brokerage house that's more, you know, like they do business with traders, right? Not ordinary banking clients. You know what I mean? Okay. If you need help getting an account set up, just let me know and I'll help you out. Okay. All right. So next couple of candles, pin bar dojis. So your pin bar dojis just basically shows that the body is just laying, like the body rests on a support or resistance level, and the wick trades below those levels, right? That's all it represents. Okay. 2 bar reversals. So your 2-bar reversal is just basically showing you 2 bars of equal strength, and there's really no direction that's pushing it. There's no bias that's pushing it in either direction. Your inside bar is this is kind of like the opposite of the key eclipse candlestick patterns. Inside bar just represents consolidation of volatility, meaning that instead of the price swings getting wild, having wild swings, the price swings is narrowing, right? And that's where we have the consolidation and volatility. And as you guys know, consolidation and volatility leads to wider volatility, right? And then wider volatility leads to consolidations within volatility. So you have like that cycle of behavior taking place. Again, here's an example of that. Your outside bar. So your outside bar is just the reversal of the inside bar. It's just showing you higher volatility that's taking place. Your
Isn't that an eclipse?
I'm sorry?
Isn't that an eclipse?
Yeah, it's similar. Very, very similar. I mean, like here, the eclipse is this one, right? The eclipse is this one where your first candle is small and your second candle engulfs the first candle, right? So it's kind of like this. Your volatility is widening, right?
Yeah.
Right? So here you're basically, the outside bar is basically the same thing, right?
Mm-hmm.
Right? It's basically the same concept, so to speak. Okay. So it's very similar to an eclipse. Okay. Here's your 3-bar reversal. You know, your 3-bar reversal is just characterized by 2 small candles, followed by 1 large candle that is just basically reversing the direction of the 2 smaller candles from the first one. The line of least resistance, very similar to the 3-bar reversal. This is just you know, it's just showing you like a 1-2 reverse type of thing. Here's your 3-bar pullback. Shows you that an uptrend is taking place, and then it's followed by a 3-bar pullback, and then the continuation of the trend. So here's examples of that. Trends in the markets. So as I've mentioned to you guys in the markets before, when looking at markets, right? One of the easiest ways to get your bearings when it comes to technical analysis, right, is to open up a chart, look at the chart from like a large perspective, and ask yourself the following question, right? You know, ask yourself the following question: is the trend going down? Is the trend going up? Or is the trend going sideways, right? Open this up, open up a chart, put it onto like a daily or 4 hours, and then just look at the chart. And when you look at the chart like this, right, you should be able to get a sense of whether or not the product you're trading in like the last 3 months. So here is a daily chart of USD CAD, and this is, you know, I'm seeing information all the way back to 2017, right? But what I want to focus on is, more importantly, is that in the last 3 months, so like this area around here, in the last 3 months, guys, is this, would you say this is doing an uptrend, a downtrend, or is going sideways?
I say it's going fairly sideways.
Yeah.
This piece right here.
Yeah, you can make an argument for it going sideways. What about you, Andy?
I'd say it's going down.
Yeah, so if you look at like from like August, right, we can say that the market has been doing kind of like this. We can say the market has found some resistance here, and it has pretty much gone sideways, so to speak, right? If
Yeah,
we
but from a further level, it's
exactly, but if we zoom out a little bit more, we can see that, you know, if we look at like the entire year, you can see that the market is relatively doing this, right? So this is what I mean. You take a look at the bigger picture, right? Like a daily, and from here you can say, okay, I know this is going down, trending down. I know this is trending up, or I know this is trending sideways, right? Looking at this from like this perspective, I would say USD CAD is more likely to be trending down than to be trending up. Would you guys agree?
Agreed.
Yeah. Okay. So now that you guys agree that, next thing you have to do is you have to understand how to begin to plot strong support and resistance levels, right? Which is the next most important thing to take away from this lesson, is understanding the direction of the market, But then the most important thing is understanding the concept. Where is it? Oh, I don't discuss support and resistance in this. I thought it was in this module. Or maybe it's in the next one. Okay, here. No, here. Support and resistance. Okay, here. Okay, so the idea here is that once you zoom out, you're going to be able to identify support and resistance levels, right? So support just represents levels to the downside, right? Any price that's testing to the downside, that's a support. Any price testing to the upside would be a resistance. So if I plot a line, let's say, for example, if I plot the line up here that ran through these 3 points, all right, let me clear all this. That ran through these 3 points here, I am plotting a resistance point, okay? That's my resistance point. And if I do this, then I am plotting my support point. Okay, so that's support, that's resistance in the markets. And support becomes resistance and resistance becomes support. So it's important to understand those concepts in the markets because it helps you to identify and to help to better draw out lines on the charts. That makes sense. When drawing lines on the charts, you want to plot at minimum 3 points. Right? The more points that a line hits, the stronger it becomes. So you see here, 1, 2, 3, and then we move this back more. And the more we move this back, you see the more that it hits, right? So we can see the market, you know, hit these points through here, right? And that's what makes this price level, the support level right here, this level, very, very strong, okay? So the more points that it runs through, the stronger it is. Same thing to the upside or to the downside. When you're drawing technical analysis, the more points you can hit a line, the better it is. And as you can see, my points aren't perfect. Sometimes they overshoot, sometimes they undershoot. They aren't perfect. Sometimes they don't even reach. Sometimes they overshoot. They aren't perfect. But the idea is that as long as the markets remain within the confines of that line, then it should still hold. What I mean by that is this. If I have a downtrend like this, and you guys see this downtrend here, right? Right?
Mm-hmm.
You guys see this downtrend here. You see that sometimes the market overshoots here above that trend, and maybe even here, it overshoots it a little bit, right? It overshoots a line a little bit. That's fine. Sometimes it overshoots. But my point here is that as long as the market stays trading below that line, below that red line, right? Anytime the price comes near this red line, it acts as a resistance, holding it down. And as long as it holds it down and holds it below this area here, that trend line there is solid. It's a good trend line. Okay, it no longer becomes a good ascending triangle when the market, let me put that back. Here. So let's say when the market starts to come up and trade against this line and breaks above it, and I would say this comes here, tests that, and then begins to trade higher, right? You guys know the concept. Support becomes resistance and resistance becomes support, right?
Yeah.
Right? So that's the idea. This here is acting as a resistance. That green line going down here is acting as resistance, right? But when we broke above it, and then we came back and then we bounced off of it. So this is the idea of support becoming resistance and resistance becoming support. When the market breaks above that, and then begins to trade higher and away from that trend line, that is when you can confidently say this technical pattern that I was trading in the market is no longer valid. All right? As long as that green line there in the market is holding steady to push the price downwards, then I can continuously trade to the downside, right? If the market comes here and that green line acts as resistance and pushes it down, then my bias in USD CAD will always be to the downside. Until that line, that green line is broken to the upside, right now you should be biased to the downside for USD CAD. Okay?
Australian dollar to Japanese
So that's the idea of using support and resistance. Again, support and resistance is one of the most fundamental concepts of this lesson. You must be able to identify support and resistance. In fact, the best thing you can do for your trading, right, is to identify support and resistance properly. If you cannot identify support and resistance levels properly, you will struggle a lot in trading. You'll probably lose a lot of money in trading until you figure out where are the key levels in which smart players in the markets, big players in the markets, institutional traders in the markets are positioning themselves around, right? Smart money just doesn't buy in at anywhere on the price, right? Smart money is looking for very good areas in which they can get the most bang for the buck. And that's how you have to think. You have to think like smart money. You can't be thinking like retail traders or retail money, because that's not going to work for you. Okay? So understand support and resistance. Understand the dynamic trends in the markets, whether it's going up, it's going down, it's going sideways. Understand how to do that. Understand how to plot charts properly. These are some of the most fundamental things that will help you with charting in this first lesson. Okay? Here, trends here. No trends. Okay, so levels is pertaining to support and resistance, as I've mentioned. Levels act as areas where it'll either break through. So, for example, using USD CAD here as an example, this level right here, the reason why I am bearish on this is because I anticipate this level here to break through and go lower, right? If it doesn't break through, then it will reverse. So there are two types of trades that we call this. We call this a breakout trade because it broke out of this level. It broke out of this box and now it's trading lower. That's a breakout trade. Or you call it a reversal trade, where that level acts as a very, very key price level in the market and holds it and causes the price to bounce from there, right? So that's what we call the green would be a reversal trade, where the market bounces off of this level and reverses. Or it could be called a breakout trade, where the market follows a red line here and breaks out of this price level and trades into a new level. So levels can be created in many forms. You can find levels in the forms of highs and lows, intraday highs and lows, weekly highs and lows, monthly highs and lows, yearly highs and lows, all-time highs and lows. Those work. Yesterday's closing price, gap levels, points of controls, like we've discussed in market profile when the market trades sideways, points of control. Using gaps or Fibonacci's will also act as strong levels. Yes. Yeah. Okay. That's pretty much it for this module. Do you guys have any questions?
I'm good. I'm getting a good understanding of what you're talking about now.
Yeah. Does it make
Yeah.
Andrew, you think it makes a little bit more sense that we refresh this now than the first time we covered it?
Oh yeah, definitely.
Okay.
Definitely.
Perfect. Good. I'm glad. Thank you for the feedback. Okay. Let me get the second module now. After this, it's just more of like hands-on practice for you guys. So again, you mean like you just draw your charts, play around with your charts. I know you were doing some of it before. If you're still doing it, send it to me and I'll give you more feedback on it. Right?
Yeah, for sure.
Okay. So here, in the second part here, we focus more on time distortion. So we understand that depending upon which market you trade, whether it be stocks or Forex, In the stock market, you trade from 9:30 to 4. In all other markets, you either trade 24 or 23 hours a day, right? And so you have to take that into account when you trade because it will affect your strategies. In addition to that, when you're looking at the time frame in the market, you have to understand, is your strategy more related to short-term capitalization in the markets or more long-term, right? Like, are you looking for are you looking for an investment, or are you just looking for a quick trade, right? Once you understand that, you can begin to manipulate the chart so that it can work for you, right? So somebody who's day trading would be more interested in looking at smaller time frame prices than somebody who is investing, right? And so those types of things become very, very important to your strategy and your strategy development. So time frames, depending upon your strategy, you'll be using different time frames. And the time frames, as I've mentioned before, they will also affect and distort the way you see the charts. When it comes to trading in the markets, I think most of you guys you're interested in the Forex market, right? More so than the stock market?
No.
Yeah?
Yeah, I'm more interested in the Forex.
Okay, that's fair enough. Excuse me. In the Forex market, you're essentially trading a 24-hour market, right? With the exception of the weekends. So you guys don't have to worry about like the stock market's trading hours. You know, you have access to the market 24/7. It's a much better market to trade. But when you're trading the Forex market, you have to know that the Forex market and its 24-hour trading cycle is broken down to 3 different sessions. These sessions are referred to as Asia Pacific, European, and North American. In the 24-hour trading cycle, we actually start off the cycle in the Asian Pacific market, right? So you can literally start trading the Forex market at 6 p.m. on a Sunday, right? That's when Asia Pacific begins to trade. So Asia Pacific tends to have like the lowest volume traded in the markets, very illiquid type of hours to trade. It's not the greatest, but that's when the market starts to trade. The market really begins to pick up when you get into the European session. And the European session is characterized from 3 a.m. all the way up to 12 p.m. Eastern Standard Time. That is when the European guys begin to start trading, and that's when more volume in the markets begins to pick up. Much, much better for trading at that time. And then lastly, you have North American session. So North American session, you'll notice that there's an overlap between European and North American trading session. That overlap in time, usually around like 9, 10 in the morning, our time, that is the height of maximum volume in the market. That is also the best time of the day to trade, where there's the most volume, there's the most volatility, and the most opportunities to capitalize on. So in a 24-hour market for Forex, although you can trade any time of the day, not all times of the days are equivalent in terms of opportunities. So keep that in mind. You can see here on this chart, I showed you here in the green, you have the Asia Pacific volume, and you see here in the green boxes down here, this is like the lowest amount of volume that you can find. Europeans in yellow and North Americans in blue. So you can see that European and North American tend to be on par with one another in terms of volume, right? And that's where you want to be trading. And that's where this concept really kicks in, like the overlap between the European and North American session. Because most volume trades through that time, that's when you should be participating in the markets, okay? Now, the stock market's a little bit different. You know, the stock market has its own, you know, set of hours, which is only from 9:30 to 4. But because it trades in a very, you know, distinct market, there's uniqueness to this specific market that you have to focus on, right? Like there's, you know, there's less than 10 hours of trading for this product on a daily basis. So you have like factors like that you have to worry about. And because most of you guys aren't into day trading stocks, you wouldn't have to worry about this that much. I myself, as I've mentioned many times before, I don't day trade stocks. I find, you know, day trading stocks a waste of time. You're probably better off day trading in the futures market and using the stock market as an investment product. So that's where I stand on that. Okay. Now, the most important thing about this specific module here is more related to the technical patterns that we have here. Okay, so the technical patterns that we have here, the channels, the channels is just kind of like an upgrade of what we've done in the last one. But like I've mentioned before, like if you understand whether or not the market is going sideways, uptrend or downtrend, you'll be able to draw trend lines that can help you identify channels, right? Channels just represents an up channel, a down channel, right, or a sideways channel, right? And in these markets, you know, you have certain ways in which you can approach trading these markets. Okay. Head and shoulder patterns. This is a reversal pattern, right? So head and shoulder patterns look like this, or they can be a reversal pattern like this, right? This is a reversal pattern, right? So this is just basically showing you that the market wants to reverse direction and go back down, or reverse direction and go back up. Okay. A megaphone pattern is just a widening of volatility like that. It looks like that. Megaphone patterns, they can break to the upside or to the downside, but for the most part, they tend to break to the downside and not the upside. So just keep that in mind when you're trading in the markets. Megaphone patterns, I wouldn't call this a breakout or a reversal pattern simply because it's just the volatility is widening, and there's really there isn't any way to tell that it's gonna like break out of a key level or reverse from a key level unless you have more information than just a megaphone pattern. Now, wedges and pendants, these are breakout patterns, right? So these right here are breakout patterns. Pendants tend to be breakout patterns as well. So they consolidate and then they break out. And then double tops and double bottoms is the M or the W patterns. And these are reversal patterns. So of the following, you have this here. This is a reversal pattern. This is a reversal pattern. This is a breakout pattern. This is a breakout pattern. Megaphones, I wouldn't really call these a breakout patterns, and channels, I wouldn't really call these a breakout patterns as well. Okay. So yeah. But that should be about all the major distinct patterns. So we'll go over this. And then we'll stop here. I just got a message from Danny. Okay. Okay, hey, guys, can you give me 2 minutes? I gotta send Danny the link to Discord so he can get in, and then he's gonna jump in, and I'm gonna wrap this off and then have Danny cover the Elliott waves for you guys. Okay?
No problem.
Just give me like 2 minutes. I'll be right. I'm gonna take care of this, and then we'll get back.
All right, cool.
Hello.
Gotcha.
Okay. Okay, guys. Yeah, I'm back. I'm gonna try to wrap up all this, and then whenever Danny gets on, he can jump in and take over for the second part of the class, doing Elliott Waves for you guys. All right.
Cool.
You guys there? Okay. So, channels, we discussed this already. You're looking for uptrends, downtrends, or sideways markets. Again, looking at a bigger picture chart, like a daily chart, you should be able to identify this fairly easy when you're looking in the markets. When you're drawing channels in the markets, as I've mentioned before, you just look for channels where the price is just oscillating, right? So if you're looking at like a, something like this, actually, no, yeah, for example, like something like this, right? You can begin to draw like little channels like this here to help you identify where price is going in the markets. So things like that, right? That will help you identify like a channel in the market. So you can use something like that, okay? When it comes to that. Hey, what's up, Danny?
Hey, what's up, guys?
Hey, glad you could join us.
What are you doing,
Yeah,
Danny?
glad to be here. Glad to make it.
Danny, can you give me like another 5 minutes, please? I'm just wrapping up the technical patterns, and then you can just jump in, all right?
Not a problem at all, because I got to review the Elliott Wave stuff anyway. So
okay, sure.
I'll be listening in. Okay.
Okay, sure. Perfect. Okay, so channels, your bull trends, your bear channels, your bull channels. Again, when it comes to trading this, now we'll discuss trading this a little bit more later when we focus on the dynamics of trading. But the idea here is that when you're trading this, is that you want to be looking for the bounces off of these channels and using these channels here as entry opportunities and using this points up here as exit opportunities in the markets, right? But again, this is like a more advanced topic that we will reiterate and go over when we start to focus more on trading executions of products. So head and shoulder patterns, again, they typically look like this. Head and shoulder patterns, as I've mentioned, it's a reversal pattern in the markets. It's just basically showing you that the market is going to reverse, right? And we had like a couple of these head and shoulder patterns showing up in the markets very recently. I forgot which one specifically, but now you can see there's a very distinct one right here, as you guys can see right here, right? You can see the neckline right here. You see once that neckline broke, like you can tell it's a neckline, right? Because this is how you can tell it's a neckline. You see how the market broke here, went up, and then what happened? Support becomes resistance, right, guys? Boom, boom, right? So that's how you can tell, like the reversal in the head and shoulders right there. They tend to happen quite often. I believe I saw this one. No. Here. No. Anyway, so I don't remember where I saw it. I did see a couple head and shoulder patterns, but I don't remember exactly which one it was on. But again, they just represent reversal patterns in the markets, and when you are able to identify them, they do offer good trading opportunities. So a couple things to know about head and shoulder patterns is that when you're trading this, number one, you want to focus on the neckline, which is this horizontal level right here. Could be a support or resistance level. The breakout of that is usually the fruition of the head and shoulder pattern, right? It's when the head and shoulder pattern creates itself. Head and shoulder patterns do not need to be absolutely horizontal in terms of their neckline. They could come with a slope. So it doesn't have to be like completely horizontal. And last thing here is that head and shoulder pattern. You typically want to focus on the formation of the right shoulder. So ideally, you want to focus on like things like this here in the market. You wanna make sure that this right here in the market is being formed, right? So you could have something like this here, right? But until you have the market doing this here, then that becomes a head and shoulder, right? That becomes a real head and shoulder being formed out. Now, head and shoulders, when the right shoulder begins to increase higher than the left shoulder, that's when your head and shoulder patterns no longer valid, right? So if you see something like this, your head and shoulder pattern is no longer valid. So you just got to throw in that trading, that technical analysis trade when the patterns no longer play out as they should. Also, with all technical patterns, you know, you experience false breakouts within them sometimes, right? Like technical patterns work because they are a pattern that is used quite often within the markets, right? So they have a high degree of success in working, right? But just because they have a high degree of success doesn't mean that they don't fail, right? You know, the degree of success may be higher than 50, but that doesn't mean that the failure rate is probably not like 40%, right? And so examples of here on your head and shoulder patterns is showing you cases in which a very distinct pattern fails, right? And this is an example, and it does happen. So don't have it set in stone that just because this pattern says it should do this, that it will happen every single time. False breakouts do happen. So megaphone patterns here. Your megaphone pattern is just a pattern that represents increasing volatility in the markets. And then for some reason, it tends to break out to the downside quite a bit. I'm not sure why it tends to break out to the downside more than to the upside.
Because people flee from the risk, the increasing volatility.
Yeah, I was just about to say, ask Danny if he knew the answer. But yeah, thank you for the input there. I had no idea it was people fleeing from the risk.
Not a problem, buddy.
Yeah, thank you. But yeah, I mean, it actually makes sense now because you can see here, like in all of these charts here, because the volatility is increasing, it would make sense that because the price swings are very wild, like the price swing is very high, some people can't stomach the volatility, so they just get out, and then the price just begins to drop from that. That actually does make quite a bit of sense. Again, here, same thing. Wedge patterns. So wedge patterns, these are considered as breakout patterns in the markets, right? And these type of patterns work very, very well. I would say these are probably some of my favorite patterns to trade in the markets simply because they resist or support against a distinct level. And then when that level breaks, it usually leads to a large price movement, right? And the breaks in wedge patterns tend to be high probability. I want to say they're more than 50%, but I don't want to say it's like 90%, right? Because as I've mentioned earlier, technical patterns do fail, and there is there's a percentage of failure rate to technical patterns. So they're not 100%, but they do have a high degree of success. And these just happen to be some of my favorites. As I've mentioned to you here earlier, the one that I have my eye on right now is the USD CAD one right here, right? And if you take a look at this right here, as we mentioned before, we already have a very large ascending triangle being formulated on a daily chart, going into a very strong support level for this specific price, right? And so this is something that I'm looking at as a breakout trade to play. And as I've mentioned to you guys, I think this trade is probably going to break out like within like the next, I would say probably like in the first week or two of January, we'll probably see this play out. I've traded the Canadian dollar long enough to know that there's usually a very large price movement in Canadian dollar at the beginning of the year. Okay. So if you guys don't believe me, take a look at this. All right, this is experience. This is January. You see how the Canadian dollar moved like 6 cents in a very small period of time in January? Okay, that's January. Okay. See here? This is also January. This is like later in the month of January, but still January. You can see here there's usually a large price swing here too. So this here moved like 4 cents in the month of January. So historically, January tends to be a highly volatile month for the Canadian dollar. And that's why I'm banking on this trade may be playing out as such. Okay.
So this is an up or a down according to the chart.
I'm sorry.
This is up or down. You making a play up or down?
I'm making a play to the downside. Okay.
So,
Yeah.
so there's a test that support down there.
I'm sorry.
You see at the end here, it has that support there.
Here.
So yeah, right there.
Yeah.
As soon as it crashes through, you're on for down, aren't you?
Yeah, exactly. That's my whole explanation for the trade. I think it's gonna go to here. I think it's gonna go to this area right here, around 128, which is about 2.5 cents away. Right. So I think there's merit for a large move like that. Okay. So here's your basic bull wedge pattern. The key here is that it's bouncing off of a key resistance level. Here's your bear wedge pattern, and the bear wedge pattern is that it's bouncing off of a resistance, or sorry, a support level. Your pendant patterns is just basically a consolidation of price action, but with no distinct levels, right? So it's a convergence in the price.
It's almost like a flag without a pole.
Exactly. That's exactly what it is. Yeah. For this pattern, like there's no bias to the upside or to the downside, so it's a little bit harder to determine which direction the price is going to break out. You're going to need a little bit more information to figure out which direction a pendant pattern is going to break out. Okay. Here. And then lastly, you have your double tops and your double bottoms. This is also one of my favorite patterns to trade in the markets, and I'll show you guys why. Okay. I remember trading this here on the euro, right? So this here on the euro, your double top, right? That resistance level, double top, and then I had your double bottom right here too. So there was like an M. I don't know if you guys can see there. Your M and your W pattern be formulated right there, right? And what's great about this is that if you guys take a look at this, okay? What's great about this trade right here is that you have this level right here acting as resistance, and then you have this level here acting as support, okay? And then anybody want to bet what? Anybody want to bet what that is?
Long. This is going long.
Yeah, right. So this right here, if you take a look at that and you pull in your Fibonacci's, I bet you that red line right there is 50%. How crazy is that? How crazy is that? Right there, 50%.
That's neat. That's neat.
Right? So this is why I love trading this specific pattern right here, right? Is because it literally went from a double top M pattern to a double bottom W pattern and reversed itself, right? And I really like this because I made money going short euro here, and then I made money going long euro here, right? So this is why I really like trading these patterns, and the reasons why I like this is because I actually use them, right? And so I prefer to talk about things that I actually use rather than things I don't use, which is why I didn't want to talk about Elliott Wave, right, and GAN theory, right? Because I just personally just don't use that stuff, right? But for me, trading by visually being able to identify these technical patterns on a chart and understanding how to set yourself up from a trading perspective on these technical patterns, right? And then overlaying that with risk reward, that is the formula to having success in the long run, right? You know, if you do the same trades, you know, over 10 times, you're probably going to be right, like maybe like 6, 7 times, right? And that's more than enough to be profitable. Okay. So things like that becomes very, very, very important for understanding technical patterns. Now, there are many other technical patterns available in the markets, like, you know, there's like cup and handle patterns, sickle patterns, and things like that. There are many, many types of patterns, right? But I've focused on mostly the major patterns that you should be that you should know, right? And more importantly is how do you categorize these patterns, right? So as I've mentioned before, right, These right here, breakout patterns. Breakout patterns, right? This and this right here, reversal patterns. Reversal patterns, right? And the megaphones and the channels, those are to be determined based upon the direction, the momentum of the markets. But for the most part, when you identify things like this in the markets, it will really help you with your trades. Okay? Any questions, guys?
No, this is going great today.
Yeah. Well, man, like I said, I'm gonna do another review session on Thursday because I feel like the first time around we kind of like went really fast and it was kind of overwhelming for you guys. But doing it a second time around, I think it's really sticking, right? And it's probably a lot better for you guys. Okay. So we'll continue with that, but I will leave it at that for today for my part, and I will send it over to Danny, and Danny will give you guys some more information on Elliott Wave and Gann theory. How's that sound?
Thank you.
All right. So you ready, Danny?
Yeah. Hey, what's up, guys? How's your holiday going?
Hey, thanks for helping out, Dan.
Oh, not a problem, man. This is what we do. So ride or die, right? Represent for my brother.
It looks warm in Florida, man.
Yeah, it's pretty toasty. Yeah, it was like 22 today, 24 or something like that.
Sure, wear that sunscreen, huh?
Yeah, I know. You can see I'm a little pink.
Yeah, you in shorts and t-shirt, man.
Yeah.
Oh man, I just
Yeah,
got like a foot of snow dumped, man. I got to go shovel the sidewalk, man.
Yeah, well, the good news is when we just got a bunch of snow came into Eastern Europe because I'm going on the 2nd to Moldova to go skiing with my girlfriend in Brasov, which is Romania, and there was no snow, so we were like, it's kind of hard to go snowboarding with no snow, right?
Yeah.
But they just got a whole bunch dumped on them, so looks like I'll be able to. You know,
Nice.
first world problems. I can't go skiing and snowboarding because there's no snow, so I'd much rather have those problems. Okay, so yeah.
Okay, so let me end my screen sharing and then
Yeah, good call.
and
On
then
that one.
we can pass it over to you, okay?
All right, how do I do that? Let's see. All right, now I should be able to share desktop 1. Boom. Can you guys see?
Yep.
All right, perfect. Okay, so Chen came to me and said that you guys had an interest in Elliott Wave and Gann theory, and that's a big question that I'm not going to have time to address fully in 40 minutes or so because I want to open up the last part for questions and all that. In fact, Elliott Wave alone came from a one specific module that was designed for a 3-hour period. So you can see how the module is laid out. We go over something called cipher patterns, which leads into Elliott Wave. And then we have some other stuff here. So the way I'm going to do it is this. I'm going to give you guys kind of like the meat of Elliott Wave theory, because I think that that's all that we're going to be able to get into. If you guys like this, I'm going to go deeper, right? Because this was not designed to be an encyclopedic treatment of Elliott Wave theory, and nor could it be in the time I have. So I'm going to leave it up to you guys. If you guys like this kind of thing and you want to hear more of it, by all means, let me and Chen know. If you don't, that's cool too. And, we could just reallocate other material to you guys. Gann theory, I'm going to have to, reserve that for a later time, but I'll keep it on the radar for you guys. We might do one of our little impromptu sessions on it, or I can chime in and do it, tag team one of the classes, with Chen some other time. But for the moment, we're just going to start off with Elliott Wave, and I usually like to begin it. So I hope that's okay with you guys. I'm going to do my best to cover as much in the time that I have in order to give you the best treatment of the topic. But the way I like to start it, the lecture on Elliott Wave, is actually with 2 simpler patterns, if you will, that become the core components of Elliott Wave, right? Because this is a very, it's I don't want to say it's complicated. It does take a lot of practice, but it's it aggregates things, right? It aggregates information. So you keep, once you have one thing, you add to it and so forth. And you're going to see that in a lot of examples. So I hope that wasn't too confusing. Because if anything, I think that it should be motivating, because this is the type of skill that if you get good at it, there are many, many, many ways to make money and to do trading off of it. So the first one, where I'm going to start with this, I skipped over the cipher patterns. Again, if you guys like this kind of thing, let me know, and we'll schedule in to discuss the cipher patterns, because I've used them in trading. They're very, very accurate, but they do take a little bit of getting used to. And me and Chen are always very honest about this. We're going to teach you like the floodgates, right? It's like learning from a fire hose, and you're not going to be able to use every single thing we teach you, but the things that you do, we want you to get really good at. So this is one thing that if you get really good at it, both Elliott Wave and these cipher patterns, you can be very successful with it. So where I like to start is what we call the wolf wave. And the reason why it's called a wave, is going to become very clear to you in a second, but it's what we call a 5-pointed pattern. And so, I skipped over these cipher patterns, but basically, as you see, they have 1, 2, 3, 4, 5 distinct points, and the vertices that connect them have some significance in the trade. Well, the wolf wave is very similar, but I'm going to jump right into it for reasons that will be clear to you at the end. And it's what we call a zigzag pattern. So basically, if you picture in your mind what a zigzag looks like, it's that. A little bit of nuances, but basically just so you have an idea. And this pattern is really cool because the entry and the exit are built in. Okay, I'm going to repeat that. When you draw this pattern, the entry and the exit are spelled out for you. Okay, again, trading is, never 100%, but I mean that this is a very, very high probability pattern, and I've had that actually verified by quant traders other than me. So when you believe it, you see it, and other people see it too, you have reason to believe, okay, there might be onto something, right? So again, I specify that what's cool about this is that the entry and the exit are spelled out for you, whereas the other patterns are more general, right? We've been seeing that in Chen's lectures, and I stress this too, is they kind of tell you when something's going to happen. A lot of times they don't even tell you if it's up or down. You just kind of have to wing it, look at your levels and all that. But this has that added benefit. It is based on trend lines connecting certain vertices. Again, this goes back to the 5-pointed nature of the pattern. And it's pretty reliable at all time frames, which is another characteristic that is not necessarily shared with some of the other patterns, because sometimes volatility on shorter time frames will give you the illusion of like a wedge or something like that, but it's really just random noise. Whereas this is fairly reliable at all time frames. So any questions so far on my approach to this, or any preconceived notions about Elliott Wave you want to clear up, or?
Oh no.
We're
All right.
good.
Awesome. Good to hear. Okay, so there is a bullish and a bearish version of this. So we have we're first going to start with the bullish. Now, what you may notice from this graph is that, let's see if I can move this. Okay, put this up here. The little zoom thing is right in my way. I don't know if you can see that, but so we have this downward trajectory here. So why would it be bullish? This is a bullish trade if my trend is downward, and that's going to you're going to really see that when we get into Elliott Wave, why that is, right? So again, don't be confused by the fact that this is clearly a downward, like bear channel type thing, but yet it's a bullish trade, because that'll be clear to you when we talk about Elliott Wave. But anyway, how you construct it, you take these 5 points, right? There's a leg going down here, a retracement, another leg going down, a retracement, and then let's move this 5 over. I recently redid the slides in the Go Squawk format, to try to rebrand everything. So sometimes the charts aren't as nice as I'd like them to be, because I haven't taught off these slides before. But anyway, so is everybody clear on this 1, 2, 3, 4, 5 pattern? And if you're not, don't worry, because we're going to go over a bunch of examples, but it's really contingent everything from here on out is contingent upon us understanding that we have this 1, 2, 3, 4, 5 downward zigzag pattern, or in the bearish case, we'll see it's upward, but 5 points, and you connect them with lines is basically the gist of this. Now, here's where it gets interesting, right? Because based off of this, I'm going to be drawing some trend lines, okay? As you see, there are 2 of them, and those trend lines are very important. Their use is helping me determine where to enter and where to exit the trade. Because remember, I told you that there was a the strength of the wolf wave was the fact that it's it has the profit target and stop loss, or sorry, the profit target and entry price built in. So how we connect, or how we determine the entry price, is basically we have 1 through 3, right? We see this line connecting here. Okay, it's just a line segment that connects 1 and 3. The profit target is ascertained by connecting 1 and 4. All right. So to repeat, we connect these 2 points here, the 1 and the 3, and we get our entry. We connect 1 and 4, and we get the profit target. Now, why am I? So I noticed that if you notice here, this line connects 1 and 3. So I could have easily entered here or here. Why is the red arrow pointing at entry at this? Okay, it's not because it's my modules and I just know that it's going to turn around because I designed the graph. It's because there's a trend. This guy can go as far as he wants, right? But until it comes back and it intersects with this line, we don't consider it to be a trade. If you do, that's fine, because a lot of times we have bounces off of this trend line. So just to draw that real quick, we could have this, right? So if you enter on this point here and it doesn't go your way, you just know that you have to account for that with your stop loss. And how would you calculate that? You know, we'll get into the details of that in a little bit, but again, it goes down to risk reward, right? So if I see that if I enter here or here and my profit target is way up here, then I have to calculate, you know, roughly 1/3 of that for an idea for a stop loss. So is that clear so far? I know I just threw a lot of stuff at you, but
I'm carrying along fine.
Okay, good. It should be clear with some examples. So again, we have this. This is the bearish case. We have the 1, 2, 3, 4, 5, right? We have our entry connected by this, you know, these 2, again, 1 and 3 give us the entry. 1 and 4 give us the profit target. Now here in this case, I have it drawn where we, you know, hypothetically entered a trade right on this trend line. That's perfectly fine. You just have to be aware of the risks. Okay, so just worked out the way I drew it. But just to give you an idea, again, 1 and 3 give you entry, 1 and 4 give you profit target. So that's the bullish and bearish version. Again, note that this is actually going against the trend, right? Because with the bullish, we had a bear trend, and we're buying at the bottom here. Whereas with the with the bearish trade, we have a bull trend, and we're playing on this reversal here. All right. So some examples, we see this is a 5-minute chart. I used to trade a lot of currencies, so a lot of these are old slides from trades I've actually made that you know, with weird pairings like euro against GBP and whatnot. But anyway, so we have it's not so easily spelled out here, but we have this uptrend here, 2, 3, 4, 5, right? 1 and 3 are connected here. 1 and 4 are connected here. I wish. Let's see. Well, let me fix this real quick. Spell it out a little better. The wave. So you see what's going on. Uh, 1, 2, 3. Yep. So again, you see how the zigzag is working. We have this 1, 2, 3, 4, 5. This is also, I use Heikinashi on this, and this is just a pro tip, and I'll make a note of this somewhere in the slides, is that sometimes the Heikinashi makes it a lot easier for you to identify these legs, right? These vertices here. So notice with the Heikinashi, even though we have some volatility here on the wicks, we can see these clearly defined trends, which is really what you want when you when you're working with this type of trading analysis. So it's just a pro tip. And again, what makes you, with any of this, what makes you successful is practice, right? So ideally, if this is the type of thing that you'd want to trade, you do some examples and see for yourself. But again, we have the 1, 2, 3, 4, 5. 1 and 3 give us the entry. 1 and 4 give us the profit target. This is a little bit cleaner example. I try to stick with the messier examples first. This is the US dollar against the Swiss franc. So here we clearly have a bullish trade, and here I did a little bit better job with the graph, right? So I have, you see this vertex here is 1, then we go to 2, 3, 4, 5. This is actually a 1-minute chart. They're not exactly perfectly aligned to this because I think I did it on a 3-minute chart and zoomed in. But either way, the veracity, that is the truth of the trade, still holds. That we're roughly connecting. No, I guess that's not correct. I'm still connecting these here. So 1 and 3 gives us the entry way down here. 1 and 4 gives us the profit target, and we see that we hit it. If we,
Hey, that's interesting, man. I've only seen Elliott Wave being applied on like really like large time frame.
No. Elliott Wave is supposed to work at all time frames, including like second.
Seconds, really?
Yeah.
Wow. I've always shunned away from using like Elliott Wave, things like that in like 1 minute, 3 minutes.
That is, it's a good. I mean, in general, you know as well as I do that you're obviously incurring more risk when you do that, right? Because you are, shorter time frame, more volatility, you know the drill, right? But if you can see these clearly defined patterns and are able to draw these, these accurate vertices, the same analysis is going to hold. If I was to put this to 5 minute, it would just squish the chart a little bit, right?
Right.
I'm not doing these on like individual bars. That would be kind of dumb. I'm doing these on larger aggregations of the bars because here's the thing, like one thing, and Chen and I have this discussion all the time, is that it's like there's really no 100% confirmation of when you pull the trigger, right? So a lot of this analysis was gained for me as a new trader. This was some of these charts were when I was first starting to trade currencies anyway. That's why you see a lot of currency examples. But it's like I would draw out the pattern and whatever it was and be like, fuck, is it now? Now do I pull the trigger? Do I place the order now? And these type of patterns really help build confidence in being able to take that trade. But to reiterate, Elliott Wave works on all levels. As far down as you can go, but it is, as with any technical pattern, more accurate the larger you go.
Larger. All right. That's perfect, man. As I'm sorry to interrupt you. I was listening to Andy and Andrew earlier. Like, I personally don't use Elliott Wave in my own trading, and I always thought that Elliott Wave and technical indicators in general were more accurate on a larger time frame. And so so I would shun away from using this type of analysis for intraday trading. You know what I mean?
It's actually the opposite for this. So I would agree with you with every single technical indicator other than this, because there's a psychological component to Elliott Wave. Even though technically we're still talking about the Wolf Wave. Let me make sure we have time. We're still talking about the Wolf Wave. Yeah, we have time. But it's based on Elliott Wave kind of theory. So these are actually better on intraday time frames because they're driven by psychology. Whereas all the other patterns are based on levels and technicals and all that. This is based on psychology. So these are trends that people do, and there's reasons for it. We'll show you some of that. And basically, there's this, and this is why we tell you to buy on dips, right? Because you have this craze of buying, then people take profits or get stopped out on the shorts. Then you have a retracement. then you buy in and you get this zigzag kind of pattern. Well, eventually that itself gets exhausted, and then you have a retracement. So we're going to see that in a second. But let me just go through with the Fibonacci's really quick, because if you have, with any pattern, if you can stack reasons to, facts, right? Reasons to believe that you have a good trade, the more the better, right? The more tools in your toolkit. So confirmation of the pattern is done a lot of times by the Fibonacci levels. So this is really important. The vertices should align with the Fibonacci levels, right? So as you see here, this goes back to my USD Swiss franc trade. And you see we have these vertices basically perfectly aligning with the Fibonacci. So based on how I've anchored those. So if you want more confirmation that your wolf wave is done correctly, go with the Fibonacci's. And here's just basically going back through other examples and showing that. This is a good one with the USD against the Japanese yen. Again, I'm using the Heikinashi charts because even on 30-minute, the USD against the Japanese dollar does not look this pretty as Chen can. I'm sure you agree. So here's again, I like to show you the theory and show you some examples that I know did work, but also to show you examples of screenshots I've taken of trades that I've placed that I've done this pattern with. So I'm sure there's probably a way to fake this, but take my word for it. Like, I actually drew this and I went into the trade, and this is a before and after of what the thing did based on the wolf wave. All right. Any questions so far?
You're covering it good.
I'm sorry?
You're doing it good, don't worry.
Okay, cool. So it is prone to failure. Usually, at least like one person laughs off of this one. And that is when, there's a couple reasons why this one failed. First of all, this isn't, if you just look at it, it doesn't have very good alignment with the Fibonacci's, right? But the main reason why it failed was because I didn't wait. And yes, I did take this trade. So I'm having you guys learn from my mistakes. But you see, 1 and 3 should be my entry price, right? I was trying to preemptively jump it here to ride this retracement when I should have been waiting patiently for it to hit this trend line. Okay, that's very important that you understand that. Don't try to jump the gun and force the pattern to happen. The trade happens because you see the pattern, not the other way around. Not because you're trying to force that pattern to happen, which I did here. So don't do that. Right. So again, 2 reasons why it failed. First is because these vertices don't align very well with my Fibonacci's, and the second reason is I didn't even go about the trade in the own theory that I should know, which is to wait until this guy retraces to this trend line and buy it back down here, right? I went for the bearish trade off of a bullish pattern. So 2 reasons why I got fucked on that one. And also, if we had time to go over what this was, this is a very bullish pattern, right? And this one is more accurate, way more so than my shoddily drawn wolf wave here that I was trying to force when it wasn't there. So again, that's a 3rd reason why this trade didn't work out. I'm going to skip over the ABCD pattern because it's a component of Elliott Wave anyway, and I feel that the wolf wave was a little bit, I'm doing this out of time interest anyway. If you want, you can go through it in the module, or I can devote a module to it for you guys if you guys like this kind of thing. But just suffice it to say, if you want to go read about it on your own, we always provide you the modules. And there's plenty of information about it if you Google around for it. But again, we'll be very pleased to show you if you show interest in this. But there's a lot of examples where this pattern did work very well, and it's a very simple pattern too. Okay, so let's go. Without further ado, we'll check out Elliott Wave theory. Okay, so I know that this was something you guys have been asking about for a little bit, And it's something that I use actively in trading, even if I don't actually base the trades 100% off of it. It gives me an idea of where the markets will go. And Chen can attest to this because we talk about the markets all the time, and I'll be very quick to point out the Elliott Wave and, where I think it's going to go. And so, the core principle about this theory is actually quite simple, and that is that markets move in what we call impulses, which are into the trend, right? They're toward the trend, and corrections, which are against the trend. So remember, I told you guys, you never ever just see something just rocketing up, right? Even the most aggressively bullish stocks still have pullbacks, right? Because eventually people run out of money, right? They either run out of money to buy and the stock kind of stagnates for a little bit, or they want to take their profits and they sell. So you're going to eventually see, a little bit of a pullback. It just really depends on where and why that happens. So another tenet is that these are fractal in nature. Now, you see fractals all the time in trading. And if you remember what I told you guys before about why that happens, is that the fractal nature of finance is simply because price is related to itself in the past, right? If I have a stock and it's trading at $100, I'm probably not going to see it go to $5 unless something really bad happened. I'm probably also not going to see it go to like 300 unless it's Tilray, right? But we saw what happened to them later. So the point is, it's the price is always related to itself in the past, just by pure numbers, right? So it would be reasonable to say that the stock might go to 101 or 105 or something like that, but not as reasonable to say it's going to go to like 1,000 overnight. So that type of constraint basically forces a fractal nature or a self-referential nature in what we're dealing with. So, when you do some analysis on this, and there's a really great book on this written by Elliott himself. That was the first book written in like 1920. It was like 200 or 300 pages, and it went into more the details of why these are the way that they are. In general, we are dealing with, or at least there's basically two classifications of them. I'm only going to go over one. So this Elliott wave assumes that we're in a trend, either bullish or bearish. There is a side wave Elliott wave pattern, and I can teach you guys that if there's interest, but just I could literally design a whole course around Elliott wave theory alone. So we're just going to deal with the 50,000 foot view. So impulses, again, those are the things into the trend. If we're bullish, those are going to be bull runs, and bearish, the converse. There are 5 segments, and we call those segments waves. And corrections, we have 3. So the above is an example of a 5-3 wave. And it can be found on any chart regardless of time frame. Now, of course, there are scenarios that lead you to be more confident in the in your assessment of the veracity of the Elliott wave. And we're going to go over those. All right. So one thing I do have to make very clear is that there is a high degree of subjectivity to this. So as I've stressed with some of the other things, like Fibonacci's is a great example. It's an art and a science. The science part is derived from very solid math. It's been around since like the 1600s. I mean, Fibonacci sequences have been around for, as early as modern math has really existed. But the art comes into identifying those anchor points. And I hope you guys have been practicing that, because it's one of the most powerful tools in trading. And we're going to build upon it here. These aren't concepts that you forget, right? That we just shelve. They're concepts that you build upon, that we treat again and again and again. So because of that degree of subjectivity, it can be difficult for beginners or even experts. And this is important to understand, that 2 Elliott wave practitioners will generally not draw the same waves, but hopefully they actually come to the same conclusions. And so don't worry if you saw something necessarily that I didn't, or that if you would have drawn it a certain way and I drew it differently, or if my analysis conflicts with yours, because the details of, say, those vertices, that 1, 2, 3, 4, 5 thing, that's not really important as much as the direction and the knowledge you're gaining about the direction of the markets from that. Okay, So how do we, okay, so a little bit more about the trends. So again, these things are fractal in nature. So we start with the largest granularity or degree. That's usually at like day or week or even month level charts. And that's the largest. The furthest you can zoom out is called the grand super cycle. Now, don't worry about actually I might even skip this. The nomenclature isn't really that important because we typically, the notation exists for you to have 12 of these at the same time. But what I mean 12 of these at the same time is the fact that if you see an Elliott wave and you zoom in, you're going to see other little Elliott waves within that. That's what I mean by fractal. What a fractal is something that you look at and the whole thing bears traits of its components, right? So in other words, an individual set is going to be reflected in itself and the whole picture, okay? So what I mean by that is that these waves nest within each other. So this is a basic drawing of a basic Elliott wave pattern. We have 1, 2, 3, 4, 5, 1, 2, 3. Okay, those are what we call the waves. Now, if you zoom in on this, you're going to see something like this: 1, 2, 3, 4, 5, 1, 2, 3. So notice what we're doing is we're basically taking this whole thing and jamming it into one of these legs, right? So again, this whole pattern should be able to be representable in each of these legs. Okay, does that make sense? So if we go even further, we should be able to see it represented in these. So again, if I take this tiny little thing, I should be able to see that 1, 2, 3, 4, 5, 1, 2, 3 within it, and every single subsequent one after that. So does that make sense so far, the self-referential nature of this and the fractals and all that?
Yeah.
Okay, cool. So I'm going to actually reword these last two. I realize reading it over myself, they made no sense. So let's just focus on these two, and I'm gonna graphically demonstrate to you what I mean by these two rules here. So we have wave 1 starts the trend, and it's usually a correction from a trend before. So that is, we have a downtrend, and say suddenly we have a bullish reversal. That's going to be your wave 1, right? The thing that starts the trend. And wave 3 can't be the wave 3 can't be the shortest. I have here that it's supposed to be the longest and strongest. That's what you usually see, but you could also see it in wave 5 or wave 1. It's just a little bit more rare. This is typically what happens. Again, this is more of a very general, high-level view of Elliott wave theory. I didn't really get a chance to go into all the details and exceptions and nuances and all that, but if you are interested, I can tell you. Notational conventions, this is the only thing I'm going to go over, is the impulse is usually done in 1, 2, 3, 4, 5. The corrective is ABC. If you guys really get a hard on for this and you really want to dig deeper into it, the notation, actually, I said 12 earlier. Excuse me, that was an error. It's actually 9. But this is all. Yeah, go ahead.
Yeah, sorry to interrupt you. Guys, I just dropped a video linked from YouTube on sacred geometry. So it has a lot to do with fractals and the whole Elliott wave nature of what Danny's talking about.
That's a very good one, Jen. Thank you for that, because that I highly recommend you take a look at that, even if not for trading, just for like learning about reality in general, how it works.
Yeah, it's also good if you want to get on some like LSD or something, because it's very
sure.
very very trippy stuff.
Yeah, no, and like I've studied quantum theory and quantum field theory and particle physics and all this. So the very fundamental fabric of the universe is based off of this shit. So
it's based off of the fractals, right?
Yep.
Yeah.
Exactly. And the ratios that you get between these numbers and stuff. So of course it's a subset, it's a component of physical reality. I would argue that it's fundamental to physical reality. So of course you're going to see it in trading. So
absolutely. Yeah. You guys check out that video that I posted for you. It doesn't talk about trading, but it talks about the fractal concepts that Danny's discussing, and how we take this information and apply it to trading, right? As like traders, like we take that stuff, but that's really where the mathematics behind the concept that Danny's talking about comes from.
Yeah, exactly. It's a very good. It's like an hour or two or something like that. It's a documentary. If I
It's
recall.
a two-part video. If you guys like it, you can watch part two. If you I just dropped it there. It's like 9 minutes, right? If you like it, move on to part two. If you don't, if
Oh
it's
shit!
not,
I thought it was a documentary. I thought it was longer.
Maybe
I'm thinking.
I'll try to pull that one up. I think I know which one you're talking about.
Yeah.
I'll try to pull that one up.
It's that one that I'm talking about, the longer one. But now that I know that, those ones are good too. It's like a very high level.
Yeah.
Anyway, just watch it.
Yeah, exactly. Yes. Sorry to interrupt you. So yeah. Go on.
No, not a problem, buddy. That was actually a very good interruption, because if you're kind of lost or you want more information about what I'm talking about and how it applies to not just trading but physical reality itself, it's a really good thing to watch. But I'm not going to go into the notation because, as I said, we have the notational tools to deal with basically 9 levels. But really, the only one that we care about is this one right here. Because if you guys want to get into, zooming in and doing the fractal stuff, by all means, get into it. I'll be happy to give you the tools to do that. But in practice, basically, we just use 1, 2, 3, 4, 5 for the for what we call the working degree. That's the trade that I'm looking at. And if I'm zooming in, I'm going to use little Roman numerals. If I'm zooming out and I want to see the thing that's a component of, I'll use big Roman numerals. But again, and then of course the little letters here and here. Don't worry about that so much. Just when I use this notation, I want you guys to know what I'm talking about. Again, if you want to get into it, you could do that. Learn more about that yourself. I just wanted you to be prepared. If you see on my charts to see some weird Roman numerals action, you would know what it meant. So what that boils down to is this. Okay, so I have the 1, 2, 3, 4, 5. This is how you're going to draw it. And you have the A, B, C. Okay, so 1, 2, 3, 4, 5. 1, 2, 3 is just denoted by A, B, C. Okay. Now when we zoom in, you can see the Roman numeral stuff going on, but we probably won't have time to deal with that. So again, this is a chart with SPY. Again, that's the ETF that tracks the S&P 500. And we have the first leg here going to 1. Then we have this reversal that forms 2. All this big drive here forms 3. And then we go to 4 and then 5. Okay, that's a basic example of an Elliott wave. Now, if you look, you could see different opportunities for me to say, why is it that I chose this one for 3, not this one or this one? And I'm going to get to that in a second. There's some pretty good reasons why you would do it that way. But first, let me just go over some of the basics. All right, and I guess this is the reason that I was thinking about right here is that notice I have this 1, 2, 3, 4, 5. Well, guess what I have here, right? 1, 2, 3, 4, 5. 1, 2, 3. Okay, and this is on a day level, so you can pretty much be pretty confident that this is something that's reliable. Now, if you wanted to zoom in here, I can see it right now. We have 1, 2, 3, 4, 5. 1, 2, 3. So you will be able to see them on these levels too. It's just as most apparent on this right here, which is why I chose this example. Let's see. This is an example with oil. This is. Remember, I told you that these often, you could stack these charting techniques and get one or multiple trades. Chen had a good example when I first joined about the double top and double bottom, and that's really corresponded with the Fibonacci's and all that. And it was just really perfect analysis of what I'm trying to express to you guys. It's just mine are going to be a little bit different than his, right? So I use these weird cipher patterns and things like that, and combining that with Elliott Wave, we see that we could short in here, right, and pick up a trade here if we're confident in our Elliott Wave analysis and be prepared for what's going to happen over here. Sticking with this example and zooming in a little bit, again, we see that nested fractal nature, and I guarantee you if I zoomed in here, which I didn't do, I probably should have done, is to show you that you would be able to see the volatility on these candles is kind of high, so it's hard to see it on the day level with the wicks, but you would be able to see that one ABC. All right, so again, I know that this is a lot to throw at you, so I'm going to show you some examples of trades that I've actually taken with it. Hindsight is 2020. Let's look at some examples in real time. So this one was the 10-year Treasury note futures. As you guys should know by now, that's one of my favorite things to trade. So I did this analysis on that. And as you see, it's not as perfect as some of my examples, but it more or less gets the job done, right? I have 1, 2, 3, 4, 5. And again, this is, notice that this is 30 minutes as well. So you have to be prepared on those lower time frames. Remember, we were discussing about how your technicals are going to be a lot more dubious, right? Or have a lot less reliability when you zoom in, right? And the same is true to an extent for Elliott Wave, but when you get the hang of it, you actually see the patterns very well, but you need to practice. So this is one that kind of, basically work. And the ultimate test is if we can base a trade off of it, right? So here I'm expecting this to, retrace. Well, what we saw was it took its time, and it actually, I should readjust this because we did have a little breakout here, but it collapsed, subsequently. All right, and that was because of a data point. A lot of times when you see these, it's because of noise and volatility from algorithms, because these, just like any other technical technique, it's not going to give you the exact point of entry, unlike I should correct myself in that you need a little bit more tools to get that to that level. And the reason why I featured this chart is this was still within the risk management model. So this was next example is AUD against USD. And this is a spot, right? So again, this is even with 1 day granularity, you see it's still pretty noisy, but I was able to come up with this 1, 2, 3, 4, 5, and then the ABC. And so what I'm predicting here, even though we have this kind of ascending wedge or rising wedge or bull wedge, whatever you want to call it, which would predict a breakout to the upside, the Elliott wave is telling me that perhaps we're going to be retracing, further down here. And so what we see is that. Now, there's an important thing to realize is that this is actually a little bit too low to continue the Elliott wave pattern, but it absolutely cannot continue past here. If we break the base of this, that means that we have a trend reversal. Okay, so it's I no longer expect after this trade, after I made my money here, I really want to keep my eye here, because if it breaks this, then I'm probably not going to retrace, or if I do, it's gonna take a while. I may see some sideways behavior. Elliott Wave is very good for identifying trends and confirming when a trend has broken. That is to say, I see this little bull-ish period going on here. I see this retracement. When can I confirm that my bull trend has actually turned into a proper bear trend and it's no longer a retracement? And that's with what I just gave you. It's actually, if it breaks past 2, you should be a little bit skeptical. If it breaks past this origin here, which should be technically denoted as 0, but if it breaks past this, we're kind of fucked in that sense. So get out of your long trades if you're in them at that point. And we see that basically here we were saved by the bell, right? We just had a couple more, maybe a quarter of a day's volatility's worth of space between this lower bound here and what would have been certain death here. And we saw that a lot with Bitcoin. I don't have examples here, but I can show you some examples when the frenzy finally, when the Bitcoin, crypto in general, when that frenzy finally popped, we were seeing a lot of these validations of the Elliott wave. So in other words, as a confirmation that the bubble had burst and that we were in a bear trend. So that's all. From here, I move into indicators because what we gave you was the introduction to indicators. There's actually a lot more that I like to cover. They're just a little bit more advanced. You guys have seen that when I did the class on my indicators. Those are actually if you recognize the Chan demo and momentum indicator, those are mine. So if there's an interest in indicators, we can also pick up with some advanced material on that. But if you guys liked Elliott Wave, I know that's it's a very, again, subjective thing to do. So you really want to start getting practice with it. And before I open it up for questions, I just would really recommend the best way to do this is just look for this structure in the chart that you're looking at. And notice that 3 could be really long, right? That's okay, right? Don't think that they need to be the same size, okay? Just think in your mind how to see these. And I know this might be a little confirmation bias at first, but when you get practice with it, you know what's real and what's not, right? If you're forcing the Elliott Wave onto a chart, it's probably not right. If you don't see anything there, that's fine. There's probably nothing there. If you do see it, then you do have really reliable trading guidelines, right, that you can go by. So that's pretty much, we got about 5 minutes. So if you guys had any questions, feel free.
No, not really.
Andrew, any questions?
At the moment, not right now.
No?
Okay.
No.
Okay, so you guys can see how complex this subject is.
Yeah.
And, you know, at the beginning, I told you guys, this is not my forte. You know, I don't use this in my own trading. And because I don't feel that I use it and I know enough about it, then I wasn't comfortable teaching it, right? And as you can see from Danny just covering like, 40 minutes of this, I bet you guys probably have more questions now, or you're probably more confused or perplexed more so now than you were probably at the beginning of this. Would that be like a correct assumption?
I would say so.
Yeah, I mean, like it's a very complex topic, right? I mean, like it's something that, you know, like you go very deep down a rabbit hole going into this type of analysis. But like I said, there's many different ways to analyze the markets, and there's many different ways to formulate strategies around trading the markets, right? So whatever works best for you is the way you should focus on trading the markets, right?
Yeah, I completely agree. And that's why, you know, hearing the formal theory of it is going to be overwhelming at first, obviously. But the way to start, right, is really just look for this pattern, right? If you could see this, and even better, if you could see these little overlapping, you know, subsets, these fractal patterns, that will confirm or you know, give you confidence that you did the right thing. And of course, you know, you could always reach out to us. Just a heads up, my phone is completely dead, and I'll have the new one will be activated in 24 hours. My point in telling you guys this is that I got locked out of Discord, and of course it's asking me for a confirmation code. So if you've messaged me and I haven't been able to get back to you, it's because I can't get into Discord at all. So that should be cleared up in the next 24 hours, because I really want you guys to practice this and go over what you see with me.
That's a negative confirmation bias. It wants you to take a holiday.
I like it.
Yeah, so as Danny said earlier, guys, if you guys are interested in further deep analysis in Elliott Wave, in Gann theory, you know, using the cipher patterns, things like that, or using some of Danny's indicators, just let us know and we'll make it happen, right? I mean, like, in all honesty, Elliott Wave wasn't even on the curriculum, so I wasn't even going to cover that subject until Andy mentioned it, right?
Thank you, Chan.
So because you mentioned it, you know, I thought it'd be good to you know, to cover some of this information, and you can see how complex, you know, just technical analysis is, right? And you know, we've you know, kind of like just scratched the surface of technical analysis, and we haven't even discussed financial products or fundamentals, macro or micro, of financial markets, right? So you can see there's many more elements that you need to overlay. And as Danny said, right, our whole curriculum is built upon information that you learned in previous classes, right? And so everything that we learned from like Fibonacci, you see how Fibonacci was used here.
Yeah.
You see how all the other patterns that we discussed are used here, right? So everything that we've learned before is going to be built upon, right? So it's be very important that you guys keep up. and you know, sit and keep up with the subject. All right.
We'll do it.
As for next class, on Thursday, we're gonna be focusing on doing the review for the rest of the technical analysis. So we're gonna be covering technical indicators and market profile. After that, we will be moving on to financial products in January. Right. So if you guys have any more interest in Danny's stuff, you know, let me know, or you can just, you know, say it now, and we'll try to fit it in somehow. If not, we're just gonna stick with the current curriculum as it is. All right, guys.
Thank you, Jeff.
Thank you, guys.
You're welcome.
Yeah, and definitely let me know if you have any questions about this, or you want to see the other material that was in here that I didn't get a chance to cover. And also, if you still want to look at GAN theory, I can make a point to you know, include that.
Okay. So we'll just do it by popular demand. So if you guys you know, if you guys find a lot of interest and value in Danny's material, just let him know, or let me know, and we'll just book another session. But other than that, we'll just stick on the current curriculum as is. Danny's gonna be away on vacation for like 2 weeks anyway, so we won't be able to do anything anytime soon. Anyways. All right, guys.
All right. Thank
you.
you.
So yeah, Thursday we will be continuing class 8 p.m. on Thursday. Other than that, you know, what is it? Are we going to yeah? So I wish you guys a happy New Year's going into the New Year's.
New Year's Eve is tomorrow, so have a happy New Year's. Drink some for me. Don't do anything I would do.
And then I'll see you guys Thursday, or even Thursday. I mean, like, I'll make it to be determined. So I'll reach out to each one of you personally to see where you are, because, you know, some of you might be hungover. So if that's the case, then we will postpone. If like on Monday when you know, Andy and Andrew showed up, we'll just continue the class as is. All right, guys.
All right, thank you, guys.
Thank you. Happy
All right,
New Year.
man. Have a great night. Happy New Year's to you guys. Stay safe, and we'll see you guys.
Cheers.
2020.
Same to you.
All right,
Once
guys.
again, Danny, enjoy vacation. Be
Thank
safe.
you, man. I appreciate you guys being here. So it's always a pleasure, and we'll look forward to the next class.
Thank you.
All right, see you then.
All right.
Take care, guys.
Take care, guys.
Bye.
Thanks, Danny,
Bye.
for helping out.
No,
Have a great evening, everybody.
Thank you.
all right. Take care. Bye-bye.